Welcome to Invest with Neko B.
Please like this video, comment, and subscribe to our channel.
Imagine buying a fund that, promises you an 11% yield, paid out every single month, just like clockwork.
Oh, it sounds amazing. It feels like a financial cheat code, right?
Exactly. I mean, you set it up, you go about your life, and you just watch this passive income roll in.
Mm.
And there's but here, imagine the IRS stepping in and quietly taking a third of that yield before you even realize what happened.
Yeah, it is the ultimate blind spot for investors who are, just chasing those double-digit yields. People see these massive glossy numbers advertised by major funds, and they project those gross numbers straight into their retirement calculators.
Right, but the net reality, like what actually stays in your account, is an entirely different story.
A painfully different story.
And that is exactly our mission for this deep dive. Today, we are analyzing two absolute juggernauts in the covered call ETF space, both issued by JP Morgan, JPI, and JEPQ.
Two very heavy hitters.
Huge. Now, since you're listening to this, you likely already follow the markets. You know the basics of what a covered call ETF is, so we aren't going to re-explain the basic concept of selling options for income.
Right. We can skip the covered call 101 stuff.
Yeah, exactly. Instead, we are looking at the underlying architecture of these two specific funds. We've gone through the financial analyses, the ETF prospectuses, the performance data.
All the really dense fine print.
All of it. We want to figure out what they actually hold, how they survived the brutal 2022 market, that massive tax bomb we just hinted at, and ultimately a concrete framework for choosing which one actually belongs in your portfolio.
Because assuming these two similarly named funds are basically the same thing, just because they share a parent company and a general strategy, is a trap.
A very expensive trap.
Exactly. Falling into it could cost you a fortune in unnecessary taxes or, force you to endure these market drawdowns you just weren't prepared for. They are completely different instruments designed for entirely different market environment.
So to understand how different they are, we have to, look past the surface level similarities first.
Yeah.
Because the basic metrics make them look like identical twins.
They really do. I mean, they both charge the exact same expense ratio, right? 0.35%.
Yep, 0.35, and both command just massive capital. JEPI sits at roughly $44 billion in assets under management, and JEPQ is right behind it, holding about $39 billion.
Which is staggering for active ETFs.
It is, but it's how they generate their yield that requires a closer look.
Yeah.
They don't just sit at a terminal manually writing individual call options on, thousands of stocks.
Right. They use something called equity-linked notes, or ELNs.
Which sounds incredibly complicated.
It is a bit, but that is the critical mechanical difference between these JP Morgan funds and older covered call ETFs.
Yeah.
An equity-linked note is essentially a customized synthetic debt instrument.
Okay. Synthetic debt. What does that actually mean for the fund?
Well, instead of JP Morgan executing millions of microtransactions to write options on individual stocks, they essentially go to a massive global investment bank and create a contract.
Oh, so they outsource the legwork.
Exactly. The bank agrees to package the returns of a covered call strategy and deliver that premium to the ETF as a neat monthly payout. It's highly efficient for funds managing $40 billion, but it fundamentally changes what you, the investor, actually own.
Right. You're essentially holding a portfolio of stocks plus an IOU from an investment bank that pays you a high yield.
A very lucrative IOU, but yes, an IOU.
And the rules of that IOU involve writing out-of-the-money covered calls.
Mm-hmm.
Let's make that tangible for a second. It's a lot like owning a rental property in a booming neighborhood.
I like this analogy.
Yeah, so the stocks are the house. You rent the house out, and that rent is the monthly premium from the ELN. But the out-of-the-money part means the renter has a contract clause saying if the house appreciates by 5% this month, they have the right to buy it from you at that capped price.
Right, they cap your upside.
Exactly. But if the house doesn't appreciate that much, you keep the house, you capture whatever small appreciation happened, and you keep the rent. You're basically leaving a buffer for growth before the cap kicks in.
That's a highly accurate way to visualize it. You are capturing the underlying dividend, the option premium, and a defined slice of capital appreciation.
So it's not a flat cap.
No, not at all. But the defining factor of how that property performs isn't just the rental contract, it's the neighborhood the property is built in.
Oh, the underlying index.
Precisely. And this is where JEPI and JEPQ diverge completely. Let's look at the foundational index, the neighborhood. JEPI is built around the S&P 500, but it uses a proprietary active management strategy.
So they aren't just buying the whole S&P.
Right. They select a highly defensive, lower volatility subset of that index. The managers are deliberately picking mature, established cash flow generators. We're talking about heavyweights like, Johnson & Johnson, Hershey, or Progressive.
Okay, so JPI's underlying engine is designed to be a shock absorber. It actively avoids the highly volatile components of the broader market to just protect the principal.
Exactly. It's playing defense.
But then you look at JEPQ, and the strategy completely flips. I mean, it's a totally different neighborhood.
Completely different. JEPQ is built on the Nasdaq 100. By definition, that index is heavily concentrated in the technology sector, which is inherently volatile.
Oh, massively volatile.
Yeah, it is completely dominated by the Magnificent Seven tech giants. When you buy JEPQ, you are taking on massive exposure to NVIDIA, Apple, Microsoft, Amazon, Meta.
So there's no defensive filtering happening there at all.
None. You are taking the raw, explosive power of the Nasdaq and writing options against it.
Which means when the broader economic weather changes, these funds act like totally different animals. And we can see this clearly by stress testing them against the numbers from the 2022 bear market.
2022 is the perfect laboratory for this. I mean, it was the worst year for stocks since the 2008 financial crisis.
Yeah, it was a bloodbath.
It really was. The broader S&P 500 dropped about 18%, and the tech-heavy Nasdaq, it plunged a brutal 33%.
Wow. And if you're relying on a tech portfolio for retirement income, a 33% drawdown isn't just a bad year. Like, that decimates the principal generating your yield.
It absolutely wrecks your compounding.
So how did these two funds handle that kind of pressure?
Well, JEPQ, being strapped to that plunging Nasdaq, suffered a drop of around 15 to 20%.
Okay, so better than the 33% drop of the pure index.
Right. The covered call premiums that collected that rent from your analogy helped cushion the blow, but the underlying tech exposure was simply too volatile. The premium cushion wasn't thick enough to stop the bleeding of the underlying asset entirely.
But JPI's performance during that exact same bloodbath is, frankly, astonishing.
It really is.
I mean, in the middle of a historic meltdown where the S&P lost 18%, JEPI delivered a total return of roughly negative 3.5%.
Almost flat in a terrible year.
Yeah. That defensive stock selection we talked about, the Johnson & Johnsons of the world, they just didn't drop nearly as much as the broader market. And when you add in the 8 to 9% premium yield it collected along the way, that yield essentially erased the capital loss.
It operated exactly as a conservative income fund should. It held the line perfectly.
So JPI wins the bear market, hands down.
Without a doubt. In a bear market, the defensive index combined with the option premium makes JPI the undisputed winner. But, markets don't stay down forever.
Right.
When we transition into a massive tech-led bull market like we've seen in recent years, the dynamic inverse is entirely. Over a recent one-year period, JPI returned a respectable positive 8%.
Which is fine. That's decent.
It's fine, but JPP delivered 24%.
Okay, that's a big jump.
And if we stretch the timeline out to a 3-year period, JPI gave investors a 29% total return. But JEPQ, it delivered a staggering 76%.
Wait, I have to stop you there and challenge that result, because a 76% return on JEPQ fundamentally contradicts the core premise of a covered call strategy.
How so?
Well, if I'm buying the Nasdaq, I am buying it specifically for the meteoric, uncapped rise of companies like NVIDIA. If JEPQ is systematically selling covered calls on that index, it is capping that rise. So aren't I just taking all the brutal downside risk of the tech sector like we saw in 2022 while artificially capping the reward?
It does sound like a structurally flawed trade when you put it that way.
Right. How is a capped tech fund returning 76%?
It's a vital question, and it gets to the heart of how the out-of-the-money mechanics actually function in practice. You are correct that there is a massive opportunity cost. The headwind is real.
You are giving up the highest peaks.
Exactly. You give up the peaks of the tech rally. But remember, JEPQ sets its option strikes out of the money. If the Nasdaq surges, JEPQ still captures that upward movement until it hits the strike price.
So going back to the house analogy, the cap isn't flat. If the market goes up 10% in a month and the option was written 5% out of the money, you still capture that first 5% of growth plus the yield.
Precisely. And there's a second mechanical factor at play here: volatility.
Okay, how does volatility help?
Option premiums are priced based on implied volatility. Because tech stocks swing so wildly, the market charges a massive premium for the options written against them. JEPQ is harvesting significantly higher option premiums than JEPI, precisely because its underlying assets are riskier.
Oh, that makes total sense. Higher risk, juicier premiums.
Right. So between capturing a slice of the explosive capital appreciation and harvesting highly elevated volatility premiums, JEPQ still posted a 76% return.
So even with the cap, it ran hard.
Very hard. Yes, an investor holding the pure, uncapped Nasdaq 100 would have made even more. But JPQ shareholders still crushed the broader S&P 500 while collecting a 10% plus monthly yield.
It just proves the underlying index matters more than the covered call strategy itself. A capped rocket ship will still outrun an uncapped bicycle.
That's a great way to put it.
But this brings us to the most critical revelation in our sources. Because JTQ generating a 76% gross return, or advertising an 11% yield, it means absolutely nothing if the IRS treats that money differently than a normal stock.
This is the tax bomb we alluded to earlier. It is the concept of real yield versus fake yield.
And if you take away only one lesson from this analysis, it should be how the IRS classifies the income from these specific funds.
Absolutely.
Let's break down the mechanics of the tax hit. Because if you hold a standard dividend growth ETF, the payouts are mostly qualified dividends, right?
Correct.
And the government rewards you for investing in American companies by taxing those dividends at a favorable rate, usually around 15%, maybe 20% if you're a high earner. But the income from JTEI and JDBQ doesn't get that special treatment.
It doesn't. And the reason why it loops back to how the funds are built. Remember the equity-linked notes we discussed?
The IOUs from the banks.
Right. Because the ETF isn't just paying out corporate dividends, because it is paying you the proceeds of a synthetic debt contract and option premiums. The IRS classifies the vast majority of that distribution as ordinary income.
Wow. Which means it gets stacked right on top of your regular salary and taxed at your highest marginal income bracket.
Exactly. For many successful professionals or, retirees with significant taxable withdrawals, that marginal rate could easily hit 24, 32, or even 37% at the federal level.
Plus state tax.
Plus state taxes.
That drastically alters the math of the investment. Let's say you buy a fund yielding 9%, and you are in a 32% tax bracket. You aren't making 9%.
Not even close.
The IRS takes nearly a third of every single monthly distribution. Your actual after-tax yield drops to effectively 6.1%. The 9% is a vanity metric. The 6.1% is your reality.
The tax drag is severe. If you are reinvesting those dividends to compound your wealth over a 10 or 20-year horizon, losing a third of your yield to taxes annually completely fractures the compounding curve.
It's devastating over time.
It could cost you hundreds of thousands of dollars in lost potential wealth compared to utilizing a more tax-efficient strategy.
Which means we need a reliable way to disarm the tax bomb. If the underlying mechanics of the ELN force ordinary income taxes, how do we keep that 9 or 11% yield entirely real?
You apply the golden rule of asset location.
Asset location, not allocation.
Right. The account type you use to hold the asset dictates whether your yield is real or fake. You must shelter these specific funds in a tax-advantaged account.
Like a Roth IRA.
Exactly. If you purchase JPI or JEPQ inside a Roth IRA, the yield you see advertised is the yield you actually receive. It is entirely shielded from the ordinary income penalty, it pays out tax-free, and it compounds perfectly.
But if you place it in a standard taxable brokerage account, which is exactly what many investors do because they want to use that monthly cash flow immediately, you are voluntarily taking a massive pay cut.
A huge one.
You have to mentally adjust that 11% yield down to 7 or 8% before you even click buy.
Asset location is everything with synthetic income. Once you understand the tax parameters and the index mechanics, you can start building a logical decision framework for your own portfolio.
So let's build that framework right now. If you're listening, look at your own portfolio strategy. What is the fundamental objective of your capital? Are you playing defense to protect the wealth you have already accumulated? Or are you playing offense, willing to endure violent drawdowns for higher yield and growth?
The answer immediately filters out one of these funds. Let's look at who should utilize JPI. This fund is engineered for investors who are in retirement or rapidly approaching it, and who prioritize capital preservation above almost everything else.
So the defensive crowd,
Right. If you require a highly dependable monthly cash flow to cover living expenses, and a 20% drop in your principal would induce sheer panic, JEPI is the mathematically sound choice.
Because of that S&P 500 screening.
Yes, the defensive screening combined with the premium cushion acts as a reliable shock absorber. You sacrifice the highest yields and massive bull market growth in exchange for sleeping well at night during a 2022-style meltdown.
It's the conservative heavy-duty suspension. It's built for potholes, not for drag racing. On the flip side, who is JEPQ engineered for?
JEPQ is for the aggressive income investor. It's for the person who wants the absolute highest monthly yield available from a major issuer, and who explicitly wants exposure to the tech sector's growth.
But there's a catch.
A big one. The prerequisite for owning JEPQ is psychological fortitude. You must be completely willing to accept that when the tech sector inevitably corrects, your principal will suffer a sharp, painful drawdown.
Because it's still strapped to the Nasdaq.
Exactly. It is a growth and income hybrid. During a bull run, it will eclipse JEPI effortlessly. During a bear market, it will bleed.
But investors don't always have to choose just one extreme or the other. Our sources highlight a hybrid approach used by more sophisticated portfolios. You don't have to treat it as a binary choice.
No, you don't.
By holding a calculated allocation of both, you create a dual-engine system. You utilize JEPI as the steady, defensive ballast that keeps the portfolio stable during market shocks, and you deploy JEPQ to aggressively harvest those massive volatility premiums when the tech sector is running hot.
A blended allocation allows you to calibrate your exact risk tolerance rather than accepting the pure beta of a single index. But, any robust decision framework also requires identifying who should avoid the asset class entirely.
That is a crucial point. With yields this high, it's easy to assume every portfolio needs an allocation. Who needs to just walk away?
Anyone in the accumulation phase with a long time horizon. If you are investing for a goal that is 10, 15, or 20 years away, and you do not require immediate monthly cash flow to pay your current bills, covered call ETFs are mathematically suboptimal for you.
Because the opportunity cost we debated earlier, you're capping your upside when you don't even need the income yet.
Exactly. When you have decades to invest, total return and compound capital appreciation are the only metrics that truly matter. Systematically selling away your upside potential in exchange for cash you don't need to spend right now stunts your portfolio's growth.
Because they should just buy the pure index instead.
Yes. An investor with a 20-year horizon would historically be much better off skipping the options layer entirely and simply buying a low-cost, uncapped S&P 500 or Nasdaq 100 index fund.
Yeah.
You just let the market run unhindered.
It's a fantastic reality check. Don't sell your future growth for immediate cash unless you actually plan to spend the cash today. To synthesize what we've uncovered from the sources, JPI and JPQ may look identical on paper with the same JP Morgan branding and the same 0.35% expense ratio. Their underlying architectures serve radically different purposes.
Totally different.
JEPI leverages defensive S&P 500 selection to prioritize capital preservation and survive bear markets. JEPQ straps itself to the Nasdaq 100 to aggressively harvest high-volatility tech premiums, accepting significant drawdown risk in exchange for massive bull market outperformance.
And regardless of whether you choose defense or offense, you must shelter these funds in a tax-advantaged account like a Roth IRA. Failing to do so triggers ordinary income tax rates that will devastate your actual realized yield.
It fundamentally changes how you view these income products. But before we finish unpacking the research, there's one final critical detail buried deep in the prospectus data.
Oh, this is the big one.
It ties directly back to how we defined equity-linked notes at the beginning of this deep dive.
It does, and it's a structural risk that almost no retail investors ever consider when they see a 10% yield. We established that to generate this income, the funds don't just write simple options, they purchase ELNs. We defined an ELN as an IOU, a synthetic debt contract issued by a massive global investment bank.
Right, JP Morgan sets up a contract with another major financial institution to package and deliver the yield.
Correct, but a contract is only as strong as the institution backing it. Because an ELN is an unsecured debt obligation, your yield and a portion of the fund's underlying capital is directly tied to the solvency of that specific bank.
Wait, so if you hold these funds, you aren't just taking on the market risk of the S&P 500 or the Nasdaq 100?
No, you are taking on counterparty risk. What happens if the global bank issuing those ELNs experiences a systemic liquidity crisis? What happens in a 2008-style Lehman Brothers scenario where the institution on the other side of your contract simply ceases to exist?
The IOU value becomes worthless. The reliable monthly yield evaporates, and the fund itself takes a direct capital hit.
It is a mathematically small probability, especially with modern banking regulations, but it is a non-zero risk. It is a hidden layer of counterparty exposure embedded directly into the architecture of the fund.
It puts the entire concept of a financial cheat code into perspective. You think you're just buying a slice of the stock market that magically pays you 11% a month, but under the hood, you are holding a highly complex synthetic debt instrument that transforms capital gains into heavily taxed ordinary income, systematically caps your long-term wealth accumulation, and quietly ties your money to the ongoing survival of massive investment banks. It just goes to show you always have to read the fine print. Systematically caps your long-term wealth accumulation and quietly ties your money to the ongoing survival of massive investment banks. It just goes to show you always have to read the fine print.